Okay, get started.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockwell.com, CSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right. Fantastic. How is everybody doing today? We are having fun in the markets, and we have the Fed coming up in an hour. It's going to be an exciting day. The indexes are already recovering. Coffee is back at 136.50. The world is in great shape. Oil, pathetic. Okay, our favorite long right now is oil. I'm still behind on my oil. This is still pretty much where I was last week. I've got these longs. My average is currently 48.24, and we're at 47.65. So not in good shape, but I'm sorry. There's nothing I've seen, nothing that's going to get me away from the premise that we're going to go higher into the holiday. Plus, you have the OPEC meeting coming up, and so if I'm an OPEC guy, any kind of oil producer, what did we learn from the last meeting when did they do it? September, October, something like that, right? When they decided to cut production? So it'd be 6 months, whatever it was. Like it was sometime in the fourth quarter. So let's look at what's happened to oil since the OPEC cuts. Nope, not great. Look at our oil mix, otherwise it'll get confusing. Okay, so here, obviously, here's where they started the chatter of the OPEC cuts, and here's the actual cut was all the way in December when they actually cut production. So what happened? Oil went from $48 to $56, and it held that more or less until March, and then it sort of went into a free fall. Then it came back again, and now it's going down again. And it went back again on rumors of more OPEC cuts, and now it's down because they're not sure they're going to make the OPEC cut. So if I'm an OPEC member, my decision is to put 10% of, not 10%, 1%. I mean, literally 1% of my oil back online. Let's say it's even 5%. Doesn't matter what the number is, frankly. Let's say my decision is whether to put 5% more production online and sell it at $48 or maybe even $45 again, or not put it online, and we go back to $55, which is up $9 from here, like 20% higher. So I could sell the 95% oil I have for 20% more, which is $115. So I make 115% by not. I'm not talking about cutting back. I'm talking about make 115% by maintaining the level of production you have now. You have a good chance to make 115% more money, or I sell 1% more oil and I make no more than 90% of what I was making, or possibly I end up making like 80%. There's just no logical decision to be made otherwise. Now, the reason the U.S. screws this up is because we're not a country that decides what to make, how to put out oil. We are a bunch of individual guys who drill wells and they make money. And so therefore these individual guys all make individual decisions, and whenever the market has a hole in it, like if there's any kind of lag in production and the oil becomes even a little bit more expensive, tons and tons of wells come online from all these marginal guys who just want to slip in, and they're thrilled to make $1 million. They're thrilled to make $100,000 in a month. So they'll run a well as long as that well is going to make them, $10,000 a week. They'll run the well, and that's made by decisions of thousands and thousands of different drilling operations all around this country. It's a total nightmare for OPEC. And the more oil we discover, the more thousands of these people there are with their own individual wells making individual decisions, and there's no cartel, there's no oversight, there's no board that tells them to cut back. So OPEC by default has to be the adults in the room and say, okay, well, we can't help the U.S., but on the other hand, what they can help in the U.S. is they know that there's only so much that we're going to drill. They've already seen that. They've seen us drilling at max capacity a few years ago. They tried to put a stop to it. Now they see that doesn't work. So the only thing they can do, because they tried to put a stop to it by flooding production and driving the price of oil down, and they thought that would put all the drillers out of business. It did not. Because what they don't understand about U.S. bankruptcy law, and again, the difference in the system, the U.S. bankruptcy laws mean that a driller can go out of business, still be a driller. He doesn't die. People don't cut off his hands. He doesn't get shamed and disappear. He'll just, he can bust a company, and George Bush did this. He can bust a company and then turn around a week later and start a new company with new investors. So it doesn't stop him from drilling. This is what they don't understand. Bankrupting an oil company, not only doesn't it stop him from drilling, but the same guy with the new investors can go back and buy the assets of the old company for 10 cents on the dollar, and now his marginal cost of drilling is lower. So now he can drill the same oil that he was drilling last week for 20% less overhead. So all they do when they bankrupt American companies is they drive the net cost of drilling down. It's a weird concept, and in fact, it's a really weird concept for foreigners to get their head around. They don't understand the system, and they don't see that. What they see, you think see this thing when you drive a competitor out of business, when you bankrupt your competition, you don't think of them like reforming, like the Terminator thing that reforms itself. You don't think of it like coming back together and reforming, but that's what American companies do. That's what our system allows. It allows you to continue to move forward despite the setbacks. And that's great. That's a great thing about capitalism, but it's only a great thing about capitalism with the consumer protections in place. If you don't have the consumer protections in place, what happens is you bankrupt the little guys, the big guys take over, then they form a cartel, and then you're in the same boat as all the foreigners, which is great for the cartels, but terrible for the consumers and everything else. The way we have it structured, it's great for individuals, it's great for startups, it's great for the consumers. But it's all based on the bankruptcy protection laws, and you got to watch out because Trump's team is trying to chip away at those. Anyway, all right, cool. So that's oil, and that's our number one play right now. Is oil long at 47.50 or higher, with 47.50 below being the stop. Lerner says, butterfly place, you discussed why D was not a good one. Just reminding you about Pfizer is another butterfly place. Do we like Pfizer? That's a good question. Let's see, Pfizer. Okay. So what is our number one consideration in butterfly play? We like something that's volatile, but not too volatile, and tends to stay in a decent channel. Now, this is 2 years. So in 2 years, Pfizer has not really moved much off this 32 line, right? Gone down to 27, which is 20% down. It's gone to 36, which is 20% up. That's fine. That's very well behaved as far as we're concerned. So the worst thing that happens this week goes 20%. It routinely, though, moves 10%. Here's 10% down, 10% up, 10% down, 10% up. That's not so good. We don't like a lot of 10% moves because we're not going to get paid for them, and I'll show you where that is. But still, long-term trend is good. So then it comes down to the consideration of what does it cost us to set up a Pfizer play versus what's the return. And so we go to PFE, and we say, okay, so first of all, if I'm going to play Pfizer, how would I play it? Let's start off with that. How would I play Pfizer? I think they're fairly priced. We can take a quick look at their thingies. Thingies, yes, very technical. $200 billion, wow. All right, so this says their PE is 28. We'll take a look at where they are financially. They are doing $52 billion in revenue. They are making $7 billion. It sounds like a PE of 30 to me. So yeah, that's about right. Okay, so obviously if they're a $200 million company at 7, their PE is high. Okay, and they pay a fat dividend. They pay a 3.7% dividend. This is not for me. I guess it's a pharmaceutical company. They have their ups and downs. This is a high PE for me. So I'm not that interested in Pfizer as a stock. That's number one. I could easily see them correcting back to 20, which is a pretty significant drop, a 30% drop from here. So I would not play them bullish. So the bottom line is if I were going to play Pfizer, I would not play them bullish. That means I'm going to pretty much collar where we are now. So we're at 33.50. I'll probably want to buy, but here's the good part. See, now look, I can buy the $37 call. The 2019 $37 call. This might save this play. It's only $1.02 because I'm not the only one that doesn't think Pfizer is worth much more than where it is now. So for just $1.10, like $1.07 to $1.21. So for just about $1.10, I can cover the call side. Well, that now becomes an interesting concept for me. I'm only paying $1.10 for my long position. Now, what's my short cover going to be? Well, I easily think they're going to go down 10%, so I'll pay up here, and I'll pay $2 for the 30 puts because I really think they're likely to fall to 30. That's a lot more likely than they're going to go up to 40. So I'm leaning a bit bearish. I'm only paying $3 though for the 30-40 long puts and calls. So that means if I'm only paying $3 on the laying out, assuming we do quarterly sales, right? We're going to have 6 quarters. We only have 6 quarters left. We have 6 quarters left to sell. So obviously I need to get at least 50 cents a quarter just to get my money back. I'm not playing to get my money back. I want to get at least $1. So if I'm going to get at least $6 selling puts and calls comfortably, then my $3 outlay has a good chance of making 100%. So let's see what it really is. So we're running out to July. Oh, July is conveniently open. And we're at 33 now. I'm a bit bearish, so I want to sell, and here's where it falls apart again now. If I sell the 33 calls, I'm only getting paid 92 cents and they're 50 cents in the money. If I sell the 32 puts, I'm only getting 40 cents, and they're only $1.40 out of the money. So I'm going to collect $1.20, but part of it's in the money, and that's a bearish bet on my part. And then what happens to me if Pfizer makes a 10% move? If Pfizer makes a 10% move, he's stuck on that one. If Pfizer makes a 10% move to 36, then my short 33s go up to $3, and I'm out $2. I'm only collecting $1 a quarter. If everything goes great, I'm only collecting $1 a quarter. So a $2 move against me, which happens. How often does it happen? All the time. It would be really weird if they didn't move 10% in a quarter. You just have to hope that you catch them in the middle. So if I was getting paid a lot of money for the volatility, I would love this stock, but I'm not getting paid enough to take it. Because I'm basically playing Russian roulette. It's not if they make a 10% move, it's whether or not the option expires when they make a 10% move. And here's a close-up. So in other words, if I bet a 10% move in So here's expiration in November, right? And we're at 32. So at the 32 line, now I say for November, I'm going to sell 32 puts and calls. What would have happened to me? Okay, I'm sorry, it wouldn't be for November. I would sell it for January. Now, it just so happens that in January, we hit the mark, right? We came right back to the 32 line. So boom, a successful dollar. But then if I sold the next set in April at the same 32 strike, oops, here's where I sold a dollar, and we're at 33.75. So now I've lost $1.75. So here's the dollar I sold and the $1.75. So now I've wiped out all my gains. And now I'm just wasting my time. Meanwhile, my long puts and calls are decaying. The $3 I laid out are decaying over this time period. So that's not a good profile. I'm not making enough money. The ones we put in the butterfly portfolio generally make stupid amounts of money when you hit them on the head. Like they'll make 2 times in a month or something like that. Like you make incredible amounts of money when you get it right, and generally you're going to grind out a profit. So I'll show you, for example, what's actually in the butterfly portfolio. Oh, we talked about something to be added to the butterfly, but I forgot what it was. So the butterfly portfolio, I saw that we're down 10% on the butterfly portfolio. We've had some moves because of earnings. We've had some things move pretty much against it, and we'll have to do some adjustments. Who is the most recent? Is it PG? No, not really. I don't know. All right. Look at, yeah, see, Win is killing us right now. Win's like, oh, there's their entire loss is Win. Yeah, otherwise we're doing okay. Win is killing us, and Apple is very disappointing right now. Oh, and look at those Microsoft calls, too. Wait. Oh, no, those are our long calls. Wait, how is that possible? Oh, I see, we rolled those, and they went against us. I get it. Okay. So, Microsoft's at 68, 69, let's say. We sold the $70 calls, and these were rolled calls that we were losing money on. And they're showing a huge loss right now. But the reality is if we expired it at 69, these would expire worthless. So that's the problem with some, when you're doing these positions, you have to realize that things look a lot worse than they are sometimes. But that's not the case with Win. Win is really way off where we were. We sold the 115 calls and we were at 125. So that is a big loss right there. Anyhow, what was I saying? Oh, yeah. So, all right, so you forget which one it is. Let's take Valero, for example, okay? So we'll do the same math using Valero. First of all, let's take a look at Valero. We'll see how volatile that one is. Because you'll say, hey, Phil, isn't everything that volatile? And I'll say, maybe. All right, see that? Oh, let's look. Not at all as volatile, is it? Okay? We had a violent move, but it came back to its channel. It was a very violent move, though. But when did we pick up Valero? How long have we had it? I think we started this pretty recently. We started them in November. So we started them after all that, when that madness subsided. In fact, I love Valero, playing it, and it was, back in November, I decided that, that they stabilized back at a normal place, because they went way down and way back up, and we were waiting for a nice chance to come in near 60, and we got it in November. 60 is what I considered a good price, and it was nice and steady for 15. But then all of a sudden something bad happened in the middle of the year. We had a terrible dip, and then it went back. Now you've got to be careful because you never know when that's going to happen again. But this is how it usually trades when it's not doing something really weird. This is beautiful because you have a $60 stock that goes from 69 to 65. It's a $4 move. It's not even a 10% variation. So most of the time, you only get about 10% a month. Now, in Valero, well, forget what we could do. Let's look at what we did do. In Valero, we picked up the 2019 60-75 spread. Okay, and this is, by the way, when they were at 60, so it was basically a bullish spread. we took the bull call spread 60-75, so we didn't even do the normal thing. We just took a bullish position. We sold the 60 puts. So I just basically put my foot down back then, and we took a bullish position. And now we sold, and we didn't sell June. Yeah, we sold the June 62.50 puts and calls. This is the second time we sold them. We sold the ones in January. We sold ones that expired in January. Then in January we sold another set. The 62.50, the 60 puts and the 62.50 calls. Oh, what did I just do? Is that it? Yeah, right. Okay. So VLO. All right. So meanwhile, the 75 calls are 385. The 60 puts, well, are 810. So even if we did this today, it's 8 plus, what did we say? Plus 4. Well, let's say 12. All right, so it's $12 for the long. Now, how much can we make selling the June 65 puts and calls? We get back 150 plus 230 is 380. All right, so here we're getting 380 back, and if we multiply 380 times 6, that's coming out to, well, let's say $4 times 6. Let's say it's like $24. Well, let's say it's not $24, let's say it's 20. So now I know I'm going to collect $20 against what I lay out here on the back end. So if I was doing it from scratch now, I wouldn't do the 60s. I would probably do the 55s. So if I took the 55 to 6 and I took the 75 for 4, that's 10, and I'm getting 4 back in my first month. And I have 6 of them to sell, so I'm going to get 20. So I have an anticipation in that case. Oh, I'm sorry. I'm sorry. We didn't do a normal butterfly, and that's the reason. I probably didn't like it. So I said, you know what it is? I think I said at the time, I'm like, well, for $8, I'd rather sell the puts and buy them. So I think that's what we did. I think we sold them for whatever, and we bought the bull call spread specific because I don't like these prices. So instead, we took a bullish position here, and now we're just selling the short puts and calls. So it's a little different than a butterfly, but I'm just still saying the point is this pays back even if you did it the traditional way. We didn't know. We went aggressive. We sold the puts. We bought the calls, and we sold these calls up here, so we have a $15 spread protecting just in case we're wrong. But we still get to do the sale. So if all goes well for us and it doesn't go up too quickly on us, and we get to 75 eventually, we'll get $20 in bonus sales plus the $15 spread. See, that's where this is beautiful on this one. Now, but I said, had we done it the traditional way and instead sold the $75 calls, and I'm sorry, bought. I wish I got to figure this out without making a mistake. If we had bought the $75 calls to cover, and we had bought the $60 call, the $55 calls to cover, we would have spent 10, and we'd have the anticipation of selling $4 a quarter. And $4 a quarter comes out to over 6 quarters is 24. Or let's say, and like I said, let's say conservatively 20. So if I'm going to get 200% back on my money, and then I can anticipate not much variation where I'm usually going to collect my money, then that's a good stock for the butterfly. And that's the difference of the Pfizer. I'd be lucky to get my money back the way it looks. It's not enough money. It's too volatile. This one, again, ignoring this, but generally 58, 52, 52, 56, 53, 63, 58, 67, that's crazy, 54, 62. And, when something crazy happens, we ride it out. We do this all the time. We're doing it now with a couple of them. When there's a crazy move, this is what you have to learn how to do. You have to learn to ignore it and say, okay, well, I'm showing a loss. So what? It's a 2-year play. I'm showing a loss right now. I'll deal with it. If we can, we sell some more premium. We keep the loss, and we let it work itself out. Because you can look at Valero going back for years, and it's like this all the time. It's always up and down, but then it kind of settles into a channel, stays in the channel until it doesn't. Then it goes up and down. You know, that's all just based on the randomness of the crack spreads at the refinery. But that's the difference between a play that we want to have in the butterfly portfolio and one that we don't, is it's got to have that long-term stability that lets us feel comfortable spending not too much money to protect ourselves out to 2019. But short-term, we need enough volatility that the option prices are high so we get a good premium for the short-term bets that we sell. And how can we play it today? I wouldn't play it today. It's a bad bet. So there you go. Okay, that's fun. All right. Can't call in. Latch Daddy can't call in. I'm not sure what that means, Latch. Oh, well. No luck, busy signal. There's no, wait. Okay, now it's working. All right, well, that was interesting. Glad we were informed. What do you mean? You listen on the phone? Is that how that works? Is that what you're saying? I'm not even familiar with that. I mean, I thought people listen on the computer. You were bullish on the SI 1685. What is the plan now? Oh, silver. I love silver. Yeah. That's another one I really like right now. Now, for the purposes of this of general trading, it's a too dangerous trade to start recommending to people. But, oh, look at coffee with a nice finish. I mean, $1,000 while we were talking. That's always good. All right, so silver. Well, now we can afford to spend some money on silver. Silver at 1650, I like that line. I mean, with a tight stop, I really like this as a bullish trade. So, in fact, let's take one, see what happens, all right? So at 1656, if it goes a bit lower, I'd be happy to add a couple more, but we'll see what happens. I think it's just so ridiculously underpriced. And we'll see what the Fed does. The Fed might drastically affect this because if the Fed doesn't tighten, the dollar's going to go down further possibly, and that'll boost silver up. That'll be good. If the Fed does tighten, the dollar will pop, silver will get cheaper, but only because the dollar pops. So that doesn't really mean that silver's failing anything. And we talked this morning. Is what I said is I think silver's down and gold is down because the euro is up. And where is that chart? Okay, here. So if you look at the euro, this is a day chart. So here's the month of April. So in the last 30 days, it's gone from 106 to 109, 109.4. So basically it's up more than 3% in 30 days. All right? So from their perspective, gold has failed any kind of technicals it was holding, because for them gold is 3% further down. 3% further down is like $36 below. So they see gold, and again, it's hard to picture, but in euros, it wouldn't be in euros, but the point being that for them it's $36 low. So to the Europeans, they see gold as testing this 1200 line. Oh wait, I can do this. Watch. Here's or gold star XEU. I think that's gold priced in euros. There you go. Okay. So here's what they see. They saw gold gapping down, hitting the 50-day moving average, and now they saw it breaking the 200-day moving average. So for them, obviously not that number, but the point is this is by pricing gold into euros, they're seeing a big breakdown that failed this key technical support. So they're panic selling gold right now, because that's what it looks like to a European investor. And if we should be able to do silver too. So a European's chart looks worse than our chart, yet they make the same decisions we make. So for the Europeans, they see silver as having really collapsed down here and failing key technicals. And now we're going to be looking at this long-term trend line here at 14.5. That's still quite a ways below where we are now. All right, they might be looking at this 15 line from them. And again, these numbers are meaningless except for just to look at what the chart looks like then. You have to think in those terms of what does the chart look like to a European when they've got a strong currency versus us with our weak currency. So now I'm going to take this away and we're just going to look at silver. So remember what this looks like. We have this M that's basically completed the down leg. This down leg is back below the middle, just below the middle leg. So we might have a little bit further to go down to 15. It won't be 15, but whatever it is, down to the lows of here, December. All right? That's what silver looks like to the Europeans. Now, what does it look like to us? Priced in dollars. Now, the dollar has been weaker. So you see, we're still above. They're down here. So for them, that's the difference. The difference between 1650 and 1683 is what the Europeans are seeing, basically. But the December lows are way down here. These are the December lows. So the Europeans see us at the December lows. We don't see that. We don't have that panic. For them, this line broke down, and they see us back to December lows. Now, interestingly, though, because we're at these lows in December, there'll probably be European buyers, and that's going to then put buyers into the U.S. stocks because we're going to see support up here, which is technically bullish because we didn't do a full retrace all the way back. But to Europeans, we did. And that's why all this stuff is such bullshit, because it depends on what you look at a chart, the chart doesn't look the same to somebody who prices it in a different currency. So to say TA matters when you can't even agree on what the chart looks like is nonsense. And so people trading in different parts of the world have very different views of what's going on. And so so anyway, the bottom line, and so again, I care less. I'm a value investor. I think all these people are idiots, okay? I think silver is worth $16 at least. I think it's a very good firm floor. I think when you get under 16 on silver, you got to be buying it. That's why, in fact, silver is our trade of the year. And silver is our trade of the year because in December we were down here. And I said, that's ridiculous. And silver went flying up from there 20% in 2 months from when I made the call. Then it went down, then it went back up to the 20% line. Now it's back down. It's going to go back up. You got a nice opportunity to make a new entry. Okay, we didn't play silver. We played silver Wheaton. And in the, not this portfolio, in the options opportunity portfolio, how's that doing? 186. This is actually down a little bit for the month. We're down like $3,000 for the month. That's sad. We haven't had a down month in so long. But we flipped bearish. That's why. The reason is because we flipped bearish. We were very worried that we're choppy, and we don't want to take any chances with our massive profits. So, I'm sorry, but I when I'm up 186% in less than 2 years, I like to lock those profits in, and that's where we are right now. So we're not going to make money on a not moving the market with this mix at the moment. Where was I? Oh yeah, silver. So our trade on silver is this one, silver Wheaton. That's our trade of the year. We have the 15.25 bull call spread for 2019. So we're only at 1962. It's not like we're worried about this thing. Then we sold the 17 puts, and again, we're at 1962. Currently, we're up nicely. We're up $4,000, and the net of this trade was 11 minus 5 minus 4 is $2,000. So our $2,000 net entry is up $4,000. That's fine. All right, trade of the year. All right, so our trade of the year in 3 months, not 3 months, it's May. In 5 months is up 200%. No, wait. Yes, that's correct. It's 2,000 and it's up 4,000. It started 2,000, it's up 4,000. That's up 200%. So we're up 200% in 5 months. That's what we call being on track. Okay, so this trade's doing fine. So I love this trade. I was going to say it's great for a new trade, but it's not great for a new trade because we're up so much. I hate to, in other words, if you do this trade from scratch, it's now 12 minus 4.7, so it's now $5,000. It's quite a bit more than where we started. So it's not really good for a new trade. We caught a great bottom when we came in on December 19th. We basically came in at dead low. All right, going back to that thing, silver. We came in on December 19th. This was our call for an entry on silver right here. That's when we got in. So at the time, people thought I was crazy because silver looked like it was completely collapsing. And here's the view. And here's our entry. Basically, that box right there is pretty much our entry on silver. I called a bottom based on the fundamental outlook of how much it costs. My major thing when I'm looking at a commodity, how much money does it cost to pull the commodity out of the ground? And you find this out by looking at all the reports of all the different miners, and you see what their extraction costs are. Okay, we did the same thing with gold when we called a bottom on gold. It's what's the extraction cost. Then you have to look at the currency fluctuations. You have to look at if other mines are coming online, if there's any gluts in supply or anything like that around the world, if there's demand shortages or demand is waning in certain places. In certain cases, like with gold especially, sometimes the government suddenly, like India suddenly prohibited the ownership of gold. They stopped people from buying gold. That obviously caused, and India is the biggest buyer of gold in the world, so that caused a big consumer buyer. So that caused a big drop in demand too, because they all buy it for like a dowry, the traditional wedding thing. They all buy gold. So you have to look at a lot of factors, but one of the overriding factors for me is always on like extraction cost, because it goes for oil too, goes for most commodities. What does it cost to pull it out of the ground? Because really, if you get down to the price of where it costs that much to pull it out of the ground, eventually you're going to bottom out of that price. Even if you go a bit below it for a while, there's only so much time people are going to lose money mining silver before they close the frickin' mine. Okay, that's what caused the price of oil to spike up. Was we got to a point where we finally got below. Let's get back to oil. So we finally got to a point below where where most people can make money. Most of the small drillers can make money. They stopped drilling. The Baker Hughes rig count. Okay, well, let me show you. That's the beauty of this kind of stuff. So the Baker Hughes rig count. Thank you. Oh, come on. I want a chart. Seriously? Who the hell has that anymore? Okay. Wait. Did you say 2017? Yes, you did. Thank you. What the hell? Oh, okay. That's probably right. Okay, here we go. So the Baker Hughes rig count from that point in 2015 to 2016 fell from this many rigs, 1,600 rigs, to 300 rigs. And that's the swing in U.S. production. Now, since the OPEC thingy, the rig count has been flying back up, and it will keep going up until it gets back to there if oil stabilizes in the mid-50s to 60s, but it won't, I don't think, and I think we're going to probably level off in this area. But we're still going to be adding rigs. It's still plenty of places where it's profitable right now to drill new oil at these prices. As long as we're up above 45, there's plenty of places where we want to be drilling, and you'll get back to like 800 rigs. But the other 800 rigs that we used to have are not coming back because, they're not coming back under 50. When you get to 50, this many rigs. When you get to 55, 60, this many rigs. When you get to $70, everybody wants to drill. That's how it works. That's why you have supply and demand fluctuations, though. When everybody started cutting back their rigs, this thing crashed But what did we do down here? We didn't even buy oil. We bought Baker Hughes. Because Baker Hughes are the guys who rent the rigs. And they were priced like they were going bankrupt, as if nobody was ever going to drill for oil again. And the reality of that was saying, no, we're just at a low point in oil, and eventually the lack of drilling is going to cause prices to go up, and then it'll be time, and then Baker Hughes will start looking good again. You know, these things aren't that complicated. Now, remember Baker Hughes was going to get bought by Halliburton, and the deal looked like the deal did fall apart, but it fell apart very much so because of this, because Baker Hughes' business went from this to this. But the cool thing for Baker Hughes is they got like a massive breakup fee from Halliburton that covered all their losses. And again, same thing as bankruptcy though, right? Because they got the breakup fee from Halliburton, they had billions of dollars of cash sitting in the bank, like $3 billion, whatever the breakup fee was. And they have all this money sitting in the bank now, covering 2 years worth of their normal income. And now it's as if they went bankrupt though. It is as if they went bankrupt. They've got all this money. That means they have a lower cost basis than any competitors. And that means that they can now make cheaper deals with customers to drill for oil and push more rigs out the door that they can rent to people. That's the great circle of economics. That's how it all works. Everything's connected. It's holistic. Oh, that's what we should do. We should have a holistic economics. Everything is connected. All right, so we talked about silver. If Le Pen loses, will silver spike down? If Le Pen loses, the euro will be stronger, and maybe the dollar will go down. But I think that's all. I think that's crazy at this point. I don't think anybody thinks Le Pen's going to win. If she doesn't win, if she does win, then all hell will break loose. Nobody thinks that's going to happen. Nobody's pricing it in. The euro will collapse. The euro should collapse anyway, but it will. It'll finally be clear to people that the European Union is not going to survive intact. And that means the euro is a questionable currency, possibly a worthless currency down the road. I would be very, very, if I was a European, I would be very diversified with my currency holdings. And I would also be careful not to be investing in companies that are not diversified in their currency holdings. What do you think of the weak auto sales numbers? Nothing. I think that's a really overdone thing. Again, cyclical. It's the same pushback. In 2008, 2009, 2010, when we had the financial shock, but obviously very few people were buying new cars. A new car, the way Americans buy cars, a new car is a luxury. It's a discretionary purchase. We don't buy cars because we need a car. Okay, generally in America, we buy a car because it got a little dirty and we're tired of it and we want to get a new one. We don't buy a car because it's reached the end of its service life. The average American has a car for 7 years tops. And there's a huge amount of people who, obviously we lease so many of our cars, is that probably almost half the cars sold are essentially rolled over every 3 years. So there's a huge amount of that. There's not that many people who drive cars to extinction. And frankly, the laws of the vehicle emission laws and checkup laws, they don't let you drive a beat-up car. It's not that you can't just drive a car any old place. It has to pass all inspections and so on and so forth. So it becomes prohibitively expensive to keep a car running when it gets too old because you have to keep it running and clean and insured. That's the other bad thing, just keep it insured. So, there's really no benefit to having a crappy car. So people tend to get new cars more often. So, meanwhile, we went through 3 whole years where hardly anybody bought a new car because nobody had to. And the auto industry almost went bust because everybody just, literally, as soon as the economy crashes, like the next day, nobody goes to a car store to buy a car. Nobody. Because why would you? It's not an emergency. So that's why they love pushing leases, because the leases force a certain amount of people to roll over their cars on certain days no matter what. So they've got the sort of like guaranteed base of business from the leases where it's always going to roll over as long as they can talk them into another lease. people who own cars, why would they go get a new car if the economy's screwed up? If they're worried about their job, they don't do it. So you had a lot of pent-up demand. The economy didn't really start coming back heavily until 2013, 2014. So now you've got, 5 years of depressed demand, and then for the last 3 years, all those people who've been putting off buying a car start coming in. Plus, then you start getting the people who finally say, okay, now my car's 15 years old and it's falling apart. Now you have the people who have to start trading in their cars. So we have 3 really gloomy years for the auto business, and we're going to have another one. And the fact that it's going down a little bit, that's not the end. Okay, and I mean, we were selling like 11 million cars or 10 million cars when the economy crashed. Now we're selling 17 million cars, and people are worried that we went down to 16. It's not a bad thing. It's not a big negative. I am really shocked. I am surprised at how few cars the big auto dealers in America sell overseas. Our overseas sales numbers suck. It really is amazing. I didn't realize how bad it was. I mean, Volkswagen and Volkswagen, Mercedes, and Toyota just dominate the planet. And it really is incredible, like how poor Ford and GM are at marketing in other countries. And I never realized. I honestly didn't think about it before. It's a huge, and obviously it's one of the reasons we have such a big trade deficit with other countries is because we don't export enough cars. Anyhow, but that's just a general problem in the industry. The bottom line, though, is I think that the worry in the auto industry is really overdone. It's like, wow, because the sales were unrealistic. They weren't supportable. They were the result of all this pent-up demand coming in. Now, once you fill the pent-up demand, we move back to a more normal, sustainable level. All right? But the car makers don't have to sell, they don't have to sell 20 million cars to make money. They know how to make money at 10 million cars, and they'll just make different amounts of money in between. And when you look when you compare the value of an automaker in the U.S. to Tesla, let's say, who make no cars, make no money, but are priced at the same price as Ford and GM. Ford, either Tesla is ridiculously high, or Ford and GM are ridiculously low, and we've got it covered on both ways. We're long on Ford and GM, and we're short on Tesla. So we'll see what happens. Where is Ford? Ford. Ford's not in the options opportunity portfolio. Seriously? Oh, that's interesting. I thought it was. We have GM. There's our GM play. So we have the 2019, we have the 28-35 spread. We're at 33. We sold the 32 puts. We were very confident in this one. It's up a little bit. That's still playable, but there's nothing wrong with them. They're going to make plenty of money. And then the other one, we have Ford. In the long-term portfolio, we have Ford, which you were playing for the stock. We have a dividend play on them because they pay a nice dividend. Okay, what else? What do you think of all this stuff? Right? Where do you see good support on Apple? Please go. Wait. To go long, what are you doing the short 2010 one single? I'm crying about those. Apple. I guess you mean these. Oh, wait. Well, in this portfolio, this is the options opportunity portfolio, we sold the June 135 calls. We rolled those already. That's what we did. We rolled the short 110s to the June 135. Currently, those are in the money, so we can't catch a break on Apple. But meanwhile, our 100-130 spread is well in the money, and what we're going to have to do is buy more. That's all. We're going to have to buy more of these to cover if Apple stays up here. So our plan now would be essentially to probably buy the if I want to look at it quickly right now, I would probably say I want to sell these 100, cash them in for $69,000. Then we're going to take, all right, so let's say we cancel this. We're going to buy these guys back for $43,000. So that's a net $26,000. So we're going to take our $26,000, and we're going to Apple. AAPL. So we got $26,000, It's a 140 something. We have the 130 short, so we want to have at least the 130 calls. Well, let's say the 125. I like these. These are like, let's say they're 29, 30. Let's say they're $30, and we can go to the. I'm sorry. What do we say there? The 125. So we take the 125, 155 spread for 17. All right. So, Mr. Calculator, please. So that's, you said we had $26,000 divided by 1,700 per contract. That's 15 contracts we have. All right, so we have 15 contracts worth of money just on the profit, just on the profit that we're rolling out. We're going to get 60 though. So let's see, 6,000 times 17 is $352. Wow, you do that. 6,000 times 17, 102,000. That's too much money. Did you get that right? 60 contracts times $1,700 per contract. Damn it. He's dividing. Yeah, that is right. 60 contracts times $1,700 per contract, $102,000. That's too much. We're not going to do that. All right. We're going to keep it around 30 contracts, I think. But in any case, so we're going to take 30 contracts now of the 125, 155 full call spread. So there's a $30 spread, and they cost, what did we say was 13 minus 29 is 16. So basically it's half. So we'll make 100%. So if we buy those for 30 times 1,700, oh, for God's sake. I don't know why this keyboard's different than my other keyboard or something. No, it can't be. Oh, what am I doing? 13, 30, 30 times 1,700 per contract. So $51,000. So we'll flip to these contracts. It'll give us another $50,000 worth of upside protection against the short calls. We'll probably sell some puts, and then we'll roll the short calls. So currently we have 15 short puts, and those are only $2. So we can easily delete these. Then we would move this contract to a higher contract. We cash this in because, like I was saying, this is a $20-something profit. So if we spend $50,000, we're only spending $27,000 new dollars, and we'll get a $100,000 return or $90,000 return. We get a $90,000 return off the additional $27,000 we put in. So we have $90,000 worth of coverage against the short 135. That means Apple would have to be over 165 before we really lose any money. Meanwhile, though, if we want to, we're going to cancel these for 15, and we can sell the January. Where are we? We're at 145. If we sell well, I wouldn't sell the January. That's silly. We'd sell 2019. If we sell 2019, let's say the 130 puts for $9. Because don't forget, we already sold the 135 call, so they can't both hurt us. So we're not doing. In fact, we're actually going to lower our margin by selling the puts. So we cover by selling these puts. And while we're covering, we can take some of this money and use it to roll the other thing higher. But I think I'd probably be happier just sticking with the 130 puts and the 135 a year earlier short calls, and then we'll just see what happens for a while and see what happens Apple holds. Because those two sales then give us another $20 of cushion. All right, so the short story is, meanwhile, there's so many ways to adjust this trade that I'm not going to worry about it right now, and I'd rather wait until expirations, at least in this period, to see where we end up. Because we're not at June yet, but I'm saying at least wait till this expiration to see if we have a sell-off. If we don't have a sell-off, then we have to say, okay, maybe the whole summer is going to be a runaway hit, and we're going to have to make some adjustments. But there's no need to. And although it sounds drastic, what I'm saying is we already made $26,000 here. So we're going to take that $26,000 profit off the table and then initiate a new position for $50,000, which means we're going to take another $24,000 and attempt to make another $90,000 with that, or another, whatever the net is, another $60,000 net profit on that. And that's how you do it. So it's not a tragedy. In fact, frankly, if we keep making $90,000 and the calls keep going up, that's fine. Because even here, the net of the trade, even if we close the whole thing out here, see this 10,000 cancels that 10,000, so we're still up about $25,000, even though it's going against this quote. So we're at $25,000 on a bad trade. Let's take that every year. We can do that. I don't mind. So I mean, and it's obviously not. And by the way, every year can do that. And if it ever falls, if Apple ever does pull back, then we cash in on these short calls, and we get a bonus $25,000 on top of all the money we're making. Because we're past. We're not even putting our original money at risk anymore. We're just basically putting our profits at risk. That's why I love those kind of trades. What was the price Bill got in SI? I don't know. Why would I know that? Who pays attention? Ola's making money already. Wow, I am so good. $275. Very nice. $300. Do I hear $350? Come on. 300, 300, 300, 325, 325. Come on, 325. 300. It's great. So too bad I only have one, but that's the way it goes. Meanwhile, my oil's losing some money, so what the hell? Oh, no, actually, it's better. As long as I go $47.50, I'm happy. All right, so that was nice. So who else does this for you guys? Huh? Give these seminars and we make like $300 in 5 minutes. All right, so let's see. Let's pray. So the silver miners have already cut costs. No doubt many are leaving anymore. Yeah, that's what I'm saying. They don't have very far to go on the silver lines. The gold guys have done a phenomenal job. Now, the danger is that gold people have cut their costs tremendously. The gold guys have gotten their costs down to like $1,000. So they can pull gold out of the ground for $1,000. That means gold could drop to $1,000. Fundamentally, and that's what I care. See, that's what I care about. I care about fundamentally. Fundamentally, gold can drop back to $1,000. But my attitude about that is I don't play the gold, I play ADX. Because I'm like, hey, they could care less if gold. Because then you turn around and think, well, ADX doesn't care if gold's $1,000. They still make money. So therefore, I want to buy Barrick Gold. I want to buy ADX. I don't want to buy gold. I want to buy the guy who can pull gold out of the ground cheaper than anybody else. That's the guy I want to play with. On NGV7, what prices are we looking for to enter on natural gas? Let's see. NRG, natural gas. Well, I said this the other day in chat. The 320 line, I'm good with that 320 line. But there's nothing that's going to stop it from going back down to $3. If people start panicking or sentiment changes, but as a long-term trade, who was just asking me that? Oh, it was the Reuters guy was asking. I think I told the people in chat. I don't remember. I know I told the Reuters guy, though. I just remember that conversation. The thing about the natural gas, so I'll tell you what I told the Reuters guy, is the thing about the natural gas is you have this trend, this unstoppable long-term trend of more and more LNG export terminals coming online. And every time another terminal clicks online, another bit of our natural gas on a monthly basis is being shipped out of the country. Over the course of the next 2 years, 1/3 of the natural gas we produce now will be shipped out of the country. Now we're back to the thing we were just talking about before. Of course, though, as prices go up, more people will start producing marginal natural gas because there will now be this export demand. All right, but on the other hand, the constant supply of cheap natural gas, and relative to, watch this, the supply of cheap natural gas, that's 30, this is 3. The constant supply of cheap natural gas, 5 years in a row so far, will cause people who have coal-fired plants and nuclear plants to look at natural gas as an alternative way to produce energy and new projects, especially if the supply of U.S. natural gas and LNG exports from around the world begin to globalize and stabilize the natural gas prices in other parts of the world. So we've benefited tremendously from low natural gas prices. Other parts of the world have not. They're generally paying still $6 to $8 for natural gas. In Europe, it's probably 6, and in Asia, it's probably 8, something like that. So they pay way more than we do. Now, when we start exporting our gas, what's going to happen is a global amount will start to, as more and more LNG starts shipping around the world, what's going to happen is that the global prices will equalize somewhere between 3 and 6, obviously not going to be 8. But somewhere between 3 and 6, the prices will stabilize. And the more people who can make it to 3, which is us and some people in Africa and stuff like that, we in Africa can make it the cheapest. Those people are going to start dominating and exporting a lot. We become the OPEC for natural gas, basically. And we start exporting tons and tons of it to the rest of the world, giving them a cheap, reliable source of energy, which will then, in turn, drive up demand. In fact, just today, Volkswagen was making a big presentation on their natural gas-powered car. So Europe is doing a lot of investing in natural gas infrastructure. They want to build natural gas filling stations and things like that because it's clean and it's cheap, it's reliable, and it doesn't require batteries. So it's not causing other kinds of pollution. So Europeans think we don't think through that part. Americans don't think about the other things, like the fact that electricity isn't free. And people get an electric car and they think it's free. Like they're like, oh, I never have to pay the gas again. No, we're going to pay $1.80 a gallon basically for electricity. Your electric bills go through the roof. So if you have a solar home, that's fine, but that's a whole different process. But again, if you have a solar home and you need to charge a car, you can't charge a car and run your dishwasher. That's two mutually exclusive things. So, Europeans are better at thinking through the entire system's repercussions, whereas Americans just go, oh, free gas. It doesn't work that way. Even Tesla is no longer supplying free superchargers. They don't let people charge at the superchargers for free anymore, which, by the way, tonight is possibly going to show what they can do is, because if you sell a car and you promise free supercharging, and the supercharging costs you money in electricity and so on and so forth, you have to then estimate the amount of electricity that car is going to use over the course of its life, how many times it'll visit the supercharging station, and that becomes the cost of sales of the car. So, if Tesla sold their last year's worth of cars without promising free supercharging, then they have basically added whatever the cost of supercharging was to the net selling price of their car. So they will appear to have better margins selling cars for the same price, but without promising to charge it for free. See how that works? Okay. Anyhow, where were we? Natural gas, that's right. So for me, this is a dead bottom on natural gas. The more that we blend in with the world, the closer we're going to come to that $6 mark. And let's say the middle of 6 and 3 is $4.50. So let's say $4.50 is the right price. And I do think $4.50 to $5 is the correct global range once we have a full export. That's 3 years from now. But 3 years from now, I think about $4.50 to $5 should be the proper range for gas. And it'll become a lot less volatile also. It'll be pretty flatlined and be just like, hey, that's the price of gas. It goes up and down a little bit from there. Demand will pick up a bit, and maybe it'll start trending a little bit higher, but generally that'll be where we're looking at. So investing now at 320 is like a no-brainer if you're a long-term investor, and if you can stand the pain of going down to $3. There's nothing to say, because it all depends on any given day of whether, here's the things that happen. There are people who are exporting natural gas, and they're building these exporting facilities, and they are shipping it out. Now, it's a very long process to get these things rolling. So when one of them comes online, they start draining the natural gas out of the country. But in anticipation of that, you have people putting more natural gas supply online. So in any given month, either more people are going to put gas supplies online, or more people are going to be exporting gas and draining the supply. So it's going to seesaw back and forth for 3 years. This is going to happen. It'll go up and down like crazy. And if you can't take a 10% swing, and that's like $3,000 a contract, is that right? Forget NG, Forex. NG. Not 3,000. It's a penny. So a tenth of a cent is $100 per penny. No, that's right. Okay, yeah, 3,000. Okay, it's $100 per penny. So if you're not prepared to deal with $3,000 per contract swings in your price while you hold it, it might not be the best play to be in the first place, because that could easily happen. Easily. Hell, you get it to the daily. Look at what's happened to this freaking thing. 420 to 3. That's a $12,000 move in a month. $12,000 down, $10,000 up, and then we go $4,000 down, $6,000 up, 6,000 down, 2 up, and $10,000 down, and 6,000 up, and now 2,000 down. Okay? That's how natural gas plays every single month. So if you're going to make a bet in natural gas and say, oh, my risk tolerance is $1,000, why don't you just take the $1,000, give it to the first person you see on the street, because you're basically playing to lose. By the way, the other huge mistake people make is they'll say something like that, like say, oh, I'm willing to risk $1,000 on natural gas, okay? But what's the reality? If you don't take the profit at $1,000, then you're making a very incorrect risk-reward bet. Because here's the thing: at any given time, it can go up or down $1,000 very easily, right? So if you're going to play in such a way where you say, okay, I'm going to stop out if I have $1,000 loss, right? So fine, every bet's a 50-50 bet. You stop out with $1,000 loss. But if you get $1,000 gain and you don't take it off the table, well, now you're risking your 1,000, and then it goes down 1,000 again. Now you got nothing. Okay, so this is where greed is a terrible thing. Okay, because if you make $1,000, you have to say, I only was willing to risk 1,000, so therefore I made 1,000, so now I've got a profit. If you stick with that trade after you make 1,000, and all you can afford to lose is 1,000, then you're taking a very, very foolish risk at that point. You can't only look at the big gains you can make. You can just as easily make the big losses. And we did, by the way. I was in natural gas. I think when it hit 380, I think I went long. I think I went long here. And we got a terrific hit into November, but I kept doubling down and lowering my basis, but it didn't help. So I went, I bought a couple more, and I went down here, and I got a couple more. I didn't get out here. I remember that. Then it went down to here, and I was like, At that point, I was down like $40,000, $50,000 or something like that. And about 40, I think it's $40,000 at the lowest point. So maybe down here it's $40,000. But I had a huge amount of contracts. It got back to here, and I think I got even by then because I doubled down and I brought my basis down. And I only had a couple of contracts left when it went up, but I still made a fortune. So I had only a few contracts, and then I turned around and made like $20,000, $30,000. But the point being, though, that I'm trading in such a manner where I'm willing to ride that out. But you can't mess around like that. If you have to know what you're willing to do, and if you're not willing to do something like that and ride it out, this is not a good thing to be trading. It's an incredibly volatile, incredibly expensive contract that is capable of making sustained massive moves against you for no reason at all. Obviously for no reason at all, because if you bought it here and you lost all this money, if you waited 2 more months, you get it back. But only if you could afford to wait it. But then if you're an idiot and you didn't get out even and say, thank God I got my money back, you lose even more money than you lost the first time. And now it's not coming back. But what I love about natural gas, since I am willing to take that risk, especially down, so for me down here, I don't think the risk is lower than here. And maybe I'm wrong, but I don't think the risk is lower than here. So I'm willing to risk $4,000 because I think there's more likelihood that we go back up to 4. I think there's more likelihood I can make 8,000 than lose 4,000. And if we do lose 4,000, I'm happy to double down, so I'm down $2,000 on 2 times the contract. Then if we bounce to 3, I'd get back out even, and then I'd be down with a basis of $3,000. And then long term, I have huge amounts of faith. I'm willing to stick with this thing for as long as it takes, because I really think that over the course of the next couple of years, we'll be at $450. That's $15,000 higher at $450. So I'd love to stick with it and see that through. But meanwhile, at the moment, I have 0 contracts. I don't have natural gas contracts. I have the UNG, but I don't have any NGs because I've been waiting to see if it finds the proper floor. Because I'm extremely patient. And then if it starts going back over 325, I'll probably jump in then. But right now, I'm waiting to see if this actually holds it. 320 holds great. I'd much rather start buying at 3. And again, that's because I got really badly burnt back here. So when we took this profit off the table, when it hit 340, I'm like, boom, I'm done. And then so getting a pullback of 20 cents off of where we got out doesn't excite me. And even if it spikes up and I miss it, if I get back at 340, it doesn't matter. That's where I just got out. So it's not really low enough to get me excited at the moment, but I do think it's a good entry. Oh, and the bonus, of course. In the bonus, you have a hurricane season bonus. If there's a hurricane in the Gulf, this thing can spike $1 on you. No hurricanes won't make it go much lower, but hurricanes can make it jump up $1. So the closer we get to hurricane season, the more I want to have at least a few contracts long. Just in case. It's like a free insurance. Oh, the Fed. What happened? Did anything happen? Oh, the market's up, so I assume it did not do anything. All right. All right, let's take a look at that first. We'll pause and look at the Fed. FOMC. Statement. Labor market strengthens, blah, 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 blah. Oh, wait. Okay, so what do they do? Committees maintain the policy of reinvesting, voting, monetary policy action, determining size. Committee expects. What? What do they do? Oh, now I got to read it. Okay. 12-month basis, voting committees 2%, blah, blah, blah. Consistent to the mandate. Strengthen 2%. View of realized and expected labor conditions. The committee decides to maintain. No change. They remain accommodative, thereby supporting some further strengthening the labor market conditions to return. Oh, the chickens. They are such chickens. Blah, 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 blah. So nothing, no real change in the statement. I'm sure if you parse it, I think the Wall Street Journal usually has a parsing. WFJ. Fed stands pat. Data doesn't show plans for future. Okay. Recent economic slowdown is temporary. That's what I said this morning. They think the slowdown is temporary, but they're too chicken to raise the rates, even though they think it's temporary, but they're too scared to raise rates in case it's not temporary. Central bank raised rates. Investors hadn't expected the Feds to raise them. Next meeting is June. As of Wednesday, investors said 70% probability of an increase by June, while officials in the economic activity close. They point to continued strengthening the labor market. So again, they're saying the labor market is strengthening. That means we should have a good jobs report on Friday. Firmer spending from business. That is true. We are getting business spending. Despite only modest gains in household spending, fundamentals underpointing continued growth remain solid. That means they are definitely telling you that they expect to have a strong job report on Friday. All right, and what is the market reaction at the moment on the chart? And we're just bumping up a little bit, but not much. And so we were talking about that before. Oh, wow, look at the Russell. Could care less. This is not really a good reaction to not raising rates. If not raising rates doesn't get a reaction from the Fed, what does? And interestingly, the dollar went up. So that's a weird thing. The dollar popped up. So again, that's my overall concept that we're about as low as we're going to be. Oh, there goes my silver profit though. Damn it. So like I said, the dollar is about as low as it was going to be, down at 98.50. Because even the Fed not raising rates doesn't take the dollar any higher. The Nikkei's loving it, so the Nikkei expects the dollar to come back up, obviously. So it's flying higher. Let's see how we're doing. Oh. Let's see how we're doing in the active trader stuff. Oh, active. Okay. Still $100. But anyway, so I expected it to go higher than this. So I'm not changing anything. But here's oil at 47.77. Not terrible. And no change in coffee, I imagine. KC. Oh, there it is. There's coffee. KC. Oh, nice. Yeah. Of course, no change in coffee. They're closed. All right, back to work then. All right, so muted reaction, not good. If you're bullish, hedge, cash out. This is, look, if the Fed not raising rates doesn't boost the markets, what's going to boost the markets? You've already had the spectacular earnings. And now the Fed is staying on hold despite the spectacular earnings. The Fed's saying the economy looks really strong. Their outlook is good. They told you the GDP in the second quarter is going to be 4%. What else can they do? The only thing left is stimulus. The only thing left is for Trump to announce a big stimulus bill. He can't do that. He doesn't even have a budget. You can't have a stimulus bill if you don't have a budget. You can't add $1 trillion to a budget that doesn't exist. And he's not going to have a budget. That's they already kicked the can down the road until September. So what is going to drive this market higher? And if nothing can drive it higher, but many, many things can drive it lower, I would be betting on the market going lower. That's my logic. But I'm not making a big bet. I'm just basically sticking with cash. Okay, we're very, 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 very cashy. How cashy? $286,000 portfolio, $175,000 of it is cash. Butterfly portfolio. A $326,000 portfolio, $250,000 is cash. Long-term portfolio. $1.4 million, $1.1 million in cash. That's ridiculously cashy. This is nothing to buy. I feel the same way as Warren Buffett. They're always like, whoa, look at, and Apple too. They say, oh my God, Apple's got $250 billion. They should buy something. It's nothing to buy. Everything's expensive. I'll buy when things are cheap. I don't want to buy when things are expensive. And the short-term portfolio, which has just made a whole bunch of money, $421,000. Wow, that's a good one. We have more cash. We have more cash than the portfolio is worth. That's how cashy we are. We have more cash than our portfolio is actually worth. Yeah, I really don't think I can emphasize more than this. Right? It's a $421,000 portfolio that has $439,000 in cash. That is cashy. That's how much I like the dollar at 99. Okay, we don't have the bullish DX play. We have actual dollars. Yeah, F is in the long-term portfolio. I didn't feel like going over every position. It's just conceptually. What level of interest in NVIDIA chipmaker? No, it's all baked in. How come you guys don't ever tell me about something before it happens? How come everybody wants to invest in things after? Everybody knows about NVIDIA. Look, see? $23, $110. That's a 500% move. I think the word is out. I know it sounds great. I know the future looks bright. I know it's great. But you know what? I missed the move. If you had said that to me last year at $20, I would have been like, oh, absolutely, NVIDIA. What a great idea. But you're telling me this to me $90 later. Like literally 500% after the fact. I don't want it. It's too late. And you're saying that there. Currently, it's very expensive. So it's very expensive to my interest. I wouldn't short them because I believe they have a fantastic long-term growth story. But also, I certainly wouldn't be long on them at this price because they could be. What if tomorrow somebody else has a better chip? What if tomorrow Qualcomm comes out with a totally better chip that's cheaper, faster, blah 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 than NVIDIA's chips? All of a sudden, boom, NVIDIA falls apart. They lose a couple of big contracts, and everybody starts pricing for bankruptcy. That's how it goes in the tech world. They're in a great position. They're a great company. Everything's going like rockets right now, but it already happened. Can't find the Fed chart. Why should I say? Rate unchanged details crossing the data. My gut says we'll drop quickly soon. I don't know if we'll drop quickly soon, but it's not a disappointment. But it's still, again, so what? Okay. Also, they didn't actually say. They didn't say they're going to raise it in June, but it still looks like it's very likely they are going to raise it in June. So we have a reprieve, not a pardon from rate rises. Are we sticking with the Amazon 900 puts in the OLP? It's down 50% so far. What's your thoughts on the earnings cycle? I am giving it, although originally we were going to pull the stop last Friday, and we should have because we would have only been down $1. The problem with the Amazon puts, I just still think that between now and Friday we can still get that a little bit of a sell-off, so I don't want to really pull the plug until we have to. And as it turns out, it's just 415 is down to 250 now. But Amazon is down 666. That's a sign. So Amazon's down 666 today. And our puts are 48 cents today. So let's see, Amazon. Jeez. So the thing is, people have to just think of whether or not this move, 800 to 950, which is 20%, is justified based on what they've seen from earnings and everything else. Now, before the madness set in, a lot of people looked at Amazon and said, you know what, this is the right price, $550, $600, okay? $900 is a 50% increase. It's the same problem with Tesla. It's overly enthusiastic. They could be the greatest company in the world. They could be Apple. Okay, Apple's the greatest company in the world. They could be Apple. And still, when they go up 50% a year, you have to question whether or not that's realistic. Are they really growing profits and revenues at a 50% clip to justify it? And by the way, if they're not, then what are you saying? You're saying that all these people, all of them going back to the beginning of time, were idiots and did not see what you see now. Or maybe the much smaller amount of people here who are paying this amount. And by the way, when I say much smaller, here's your volume versus here's your volume. This is 100% more volume sustained in this quarter and in this around here. 100% more volume. This 100% more volume traded stock down. This 100% more volume traded the stock down. This teeny tiny volume trades the stock up. Okay, here's a big volume trading it up. Here's a big volume trading it up. It does happen. Didn't happen here. When you have weak volume going up, you can look at very possibly having strong volume going down. You got to be real careful of that stuff. And these are weeklies, by the way. These are weekly figures, not monthly. Week by week, so you get a pretty accurate idea of which way things are trending. And we're trending down and down. It goes up and up, and less people want at that price. That's not a good sign. And it's really, really stretched up here. So anyway, but we only have 2 weeks. After Friday, we only have 2 weeks for this to come down. We don't need it to come down to 900. We just need obviously we don't need it to come down to 900. We need 3 more days like this. But you have to think, is that realistic? Okay, so here we are today, and today we gained 50 cents, and we're $1.50 away still from being even. So 666 equals 50 cents. So we need Amazon to come down 18, let's say $20 to 920 for us to get our money back. 920 just to get our money back in short order. Not next week, really this week. So basically tomorrow, if Amazon isn't down another $10, we should pull the plug because it's not going to save us. We need a $20 drop by Friday. Otherwise, we may as well get out because we don't want to hold it over the weekend if it doesn't sell. So that's what we're going to be looking for. And anything less, we pull the plug. And that's what you should always do when you're looking at trades. Say, well, what could happen, and what do I need to happen to get my money? And if there's no clear view to getting your money, then you're screwed. All right, Tesla. Let's talk about Tesla because we have a bad Tesla trade, and nice. Okay. So we gutted this out, and you have to do that. You have to think about again. See this. Because we always talk when we talk about the 5% rule, we always talk about throwing out spikes, right? The trick is to learn what a spike is while you're in it. Because while we're in it, I'm like, we're going to throw this data point here. It's going to get thrown out. It's stupid. And therefore, it's just going to, and this is, I know it's just going to look like this in the toppy trend. So if we come down, anything below 300 is profit for our Tesla trade. So we only need to get to here to make money. Down here, it's all bonus money. Anything below 300 is we start getting like big profit. And I think, I think the emperor has no clothes. I think this is I really think that this whole bullshit with Tesla it's almost a scam. I don't know if it's a scam. Look, you got who's that guy? DeLorean or Tucker. There was Tucker at one point, made a great car. DeLorean made a great car, really cool. But making a great car doesn't mean you're going to ever make money. And I know you got Tesla fans, you're like, well, this is different because this is transformative. This is an electric car, blah, blah, blah. Meanwhile, there is no Model 3. And the Bolt is on the road, and people are buying them. It's a real, actual car made by GM that drives around and works, and people are loving it. And they're making it for the price that Musk said he would make a car for one day. Now, so more important than what they earn in this earnings call is whether or not they're going to be able to say, we are going to be producing a Bolt. Not a Bolt, Model 3. And the problem for Tesla is at this point now, it's June. And he can't say, he loves to exaggerate and he loves to bullshit, but he can't say in June that he's going to be putting Model 3s on the road in volume during this year if he's not. He could say it last year because it's far enough away that he could say, well, we had problems that were unforeseen. But you can't just get up and lie to shareholders. That's how you get in jail. It doesn't matter how many billions of dollars you have. That's how you go to jail. So Musk can't get up there and lie and say flat out, we are going to hit our targets in 2017 when it's the middle of 2017 if it's not true. So much, much more important than whether or not they made money. Obviously, they didn't make money. On whether they didn't lose that much money in the last quarter, it's all about, will he actually deliver a car that he's promised for the last 5 years this year? And what he'll probably say is we expect to have the Model 3 on the road by the end of the year. And you can say that, but that is not the same thing as saying we're going to ship 100,000 Model 3s in the second half of this year. And there's no way that's going to happen. It would be the biggest surprise on the planet Earth if he says that. All right. So meanwhile, then, if he's starting from zero, that means he's already missed it. All he has to do is say the end of the year, and he's already missed his entire target for 2017. It's gone. 2018 target gone. And anybody who understands the auto business understands this about Tesla. So there are people who just can't even believe this is a thing. You simply can't just flip a switch and start producing tons of cars. And as far now again, they're really secretive about this stuff. But as far as anybody knows, there's not enough capacity at the Gigafactory. There's not enough batteries for these cars. There's not enough parts of various kinds. They don't have any particular. Obviously, they have no way to sell them, ship them. They don't have any of these facilities put together yet. How are they going to double, triple their production in months? It's just not going to happen. And so far, they're shipping the same amount of cars this year as they shipped last year, quarter by quarter. And this quarter, they're going to announce that they ship the same amount of cars. And next quarter, they're going to project shipping the same amount of cars. And probably the fourth quarter, they're going to announce the same amount of cars, which means they're missing by the entire production run of the Model 3, which was supposed to be coming online in June. And he will deliver a patchwork Frankenstein piece of crap just to get something out the door. But I don't even think he can do that. So we'll find out tonight. But I think people are going to wake up and be like, okay, we're a little bit ahead of ourselves here at $300. This guy just does not have $300 worth of stuff together, and that's exactly what happened here. Anticipation, actual earnings, big disappointment, 20% drop. 20% drop from here takes us back to 250 here. Right about here. All right, and if you say 20% from 330, because he was 20% from the high. If you say 20% from 330, 270. 270 is our freaking target for the spread that we have. We have the 300, 270 barefoot spread. So Tesla is only doing exactly what we thought it would do. It's running up into earnings. He has the earnings. Everybody goes, oh my God, what the frick am I buying? And it goes back down. So I think we'll see this. I think we'll be down right here eventually. But on the whole, I am also. I don't want to I don't want to say the whole thing is a scam, but it smells like a scam to me. And again, like I said, it's a scam like DeLorean was a scam. It's a scam in that the guy tries his best to make a car, but the reality of what he can actually deliver, of what he can actually accomplish, versus the hype is a gap. Is the gap between billions and zero. Tesla lost $2 billion. They burned $2 billion worth of cash last year, and that was without SolarCity in it, which also burned like $1 billion of cash. Where the frick is Tesla going to get $3 billion this year? They can only do it by diluting. And if they don't have these Model 3s ready to roll out, and they have to announce that they're raising capital in Q4 and in Q3 and diluting people again, I just don't see any end in sight. And if people and with a burn rate the way their burn rate is, if they stop getting capital, if people get sour to them and their stock dies, and then they can't raise money at $250 a share without onerous terms, it's the beginning of the end right there. And again, I know it seems great, and he's got all these cool ideas and whatever, but he's pulling stuff off. And it's not just having cool ideas. He's got he's a great guy. He's got this vision and force and vision. I don't like him though because he's also a scammer. He'd be a great guy and not be a scammer. He's a great guy and he's a scammer. He's got this vision. He puts people together. Steve Jobs had vision and put people together, but at the end of the day, he made sure it made money. Didn't stop him from trying. Remember, he did Next Computer. Next Computer was a really cool computer. Didn't make any money. Whole thing was a bust. But he did Pixar. That worked. Changed filmmaking forever. Elon Musk has ideas. He has the ability to get people together and believe in his ideas and drive the idea forward and get it to be a reality. But that doesn't mean it makes money. And that's the test. And that's what we're going to see from this. And again, I don't mind a guy like that. I don't mind Steve Jobs bankrupting it like he tried. Okay, he did it. He came in, he did what he did, and tried. But Steve Jobs didn't come out and bullshit you that Next was doing great, and he didn't come out and bullshit you that the next computer or the next Lisa computer was going to be the one that's going to do this and that. He didn't do that. He would let the sales speak for themselves. He would say, I'm rolling out this product. In fact, Jobs didn't even announce he had a product until he had it to deliver. Then he'd say, look at this product, it's going to be great. Then it doesn't do good. He's like, wow, I didn't see that coming. He said, I thought this was the best computer I ever made because nobody wanted it. Musk doesn't do that, though. Musk will tell you how great everything's going, just like the president will tell you everything is great no matter how badly it's going. And that's where it starts to me to be kind of like a scam artist. Because at this point, he's just basically taking people's money and turning it into a venture that basically feeds his ego more so than actually provides a viable means of transportation at a reasonable price. And I don't mean reasonable and cheap. I mean reasonable at a price that makes a profit so that it's a sustainable model. Because frankly, you're also screwing, when again with DeLorean, you're also screwing your buyers because when they lay out $90,000 for a car and then 3 years from now you're out of business, the value of their car plummets. So now you've screwed them out of the car. That's wrong. So you're doing a disservice to your investors and a disservice to your consumers. You've got to be able to figure out how to make a car that makes money. Not just keep getting the next round of financing to sustain your money-losing venture. And that's where Bezos differs, because Bezos pulled it out of the hat, because Bezos has a gigantic money-losing mail-order catalog thingy that doesn't make a dime, but he figured out that because that gigantic non-profit-making monstrosity that he's built doesn't make any money, they also had all this tremendous computing capacity that was sitting around doing nothing most of the time. So he has the incredibly great idea of selling it to other people. And now all the profits of Amazon come from cloud computing, all of them. Not only all of them, 150% of the profits of Amazon, because 50% of the profits of the cloud computing are lost by the online ordering system. So the main company loses about half the profits that the cloud company brings in, but on the whole, they still make a little bit of money, so everybody's happy. If you spun off Amazon Web Services as a separate company, it would be probably a $100 billion company on its own, but then Amazon would be worthless. The remaining retail operation of Amazon would be a worthless company because it makes no money and it has no chance of making money. Okay, and why doesn't it make money? Because when you go to Macy's, who make very little money, you go to Macy's, you drive to Macy's, you take the item, you pay for it, and you carry it home. But when Amazon sells you the same item, you go on, they pack it, they take the item, they have to go get it, just like you go get it in the store, they have to go get it off a shelf somewhere, they have to put the item in a box, they have to put packing material in the box, they have to pay for the shipping of the box to your house. And this is for what? For a $20 dress? That's not a profitable venture, okay? The time of the employee, the shipping of the item, so on and so forth, when the margin on that item is like 10% in the first place. And not only that, but Amazon doesn't even make the dress. They don't make it. And they're not the buyers. Like Macy's, see, Macy's lays out. Macy's promises to buy $40 million worth of dresses from somebody, and they're going to sell them. And Macy's says, well, we're going to either make a profit or make a loss selling these dresses. So they get a really good price because they're taking on the risk. Amazon doesn't do that. Amazon gets a very tiny percentage of the sale price of the item. Not the lion's share like Macy's does. They get a small percentage of the selling price of the items because all it's doing is that they're servicing as a conduit to have the item. But meanwhile, they've got to have it at their warehouse and they've got to ship it. And they've got to have somebody pick it up and wrap it and do everything for them. It's not a profitable model. It's not a realistic way to have things done. It's not efficient. Efficient is that you go to the mall and you buy your clothes. That's efficient. You take your body to the mall, try clothes on, and buy them. That's efficient. Now, obviously, there's plenty of things that could be done on Amazon, but either way, the groceries, whatever you want to say, if you have to pack it and ship it, you're eating into the margin. And and not only are you eating into the margin, but Amazon isn't the actual store owner. They're just the middleman. And the other thing that's hurting Amazon on the retail side is now there's more and more comparison apps. Like when I buy on Amazon, not when I buy on Amazon, when I buy anything on the web, I have this app, which I don't know what it's called. Well, hang on. See if I can tell you. Oh, no, I can't. Damn it. Oh, well. I have some Google thing that's like embedded. It's like an app for Google. And it tells me whenever I'm buying something if I can find it cheaper somewhere else. Like, I don't even know how it works. Somehow, like, when you get to the checkout thing and you get a price on an item, it sort of puts a little thing on the bottom of the screen that says, and has a little alert thing, and it says, this item is cheapest here. And it's looking all over the web to find the cheapest price for whatever I'm looking at. Amazon can't deal with that. Because they're not the cheapest. There's a lot of stuff that they're not cheap at all for. People buy it because it's convenient. But when you've got programs now, when the artificial intelligence, these little bots are going around, and they start getting smarter and smarter, and they start slapping people in the face and saying, hey, you're paying $5 extra to get free shipping. Doesn't make any sense. That's going to hurt their business and erode their profits down the road, too. But anyway, so that's why we're short on Amazon. So what else is going on? What time is it? Oh, no, already? I guess we're a lot early on STR. Oh, well, should put the dividend. I don't know if the reverse split's going to end the drop. And we were early. Yeah, well, I didn't want to wait because I didn't know what's going to happen. And I didn't want to wait because $1.70, $1.60 really doesn't matter at this point. I think we may have sustained the price a little bit this morning when we were buying it. I think we're the only idiots who were sitting there buying it at this point, and then it started drifting down after we were done putting our orders in. Look, it is what it is. At this point, it's priced for. Moody says Frontier dividend cut does not impact. Moody said, here's what happened. So Moody says that they still have a negative credit outlook on Frontier. 34-year low. That's great. Because, look, obviously the 22.3% dividend was not going to be sustainable. They cut the dividend drastically. It's now 16 cents. So it's more like, obviously it's 10% now. Here's the thing that's financial. Let's take a look at that. Okay, so $4.7 billion, $5.5 billion. They spent $10 billion to buy Verizon customers Now they're at $9 billion. Okay, so they went from 5.5 to $9 billion. When they were at 4.7 billion, so when they were at half, this is a transitional year, so you can't look at it. When they were at half, they were making $133 million. It is reasonable to assume that when things calm down, forgetting any additional efficiencies of doing things, that they're going to make $266 million, not $133. Okay? And currently, the company is trading at $2 billion. So they're trading at a PE of less than 10 of what a reasonable expectation going forward would be without synergy and without anything else. Also, they paid $1,500 per subscriber to Verizon. They've got 15 million subscribers, I think, or 12 million subscribers. So 12 million subscribers times $1,500. Did I divide again? 1,500 times 12. I did it again. I don't know what the hell. Times 12. What? I know it's 18. Yay, $18 billion. Anyway, so they have $18 billion worth of subscribers. They're currently valued at $2 billion. And yes, they have debt. I think the quarterly is more paid. They got $18 billion in debt. So basically, they're a break-even operation. If they sell all the subscribers, they'll have just enough to pay off their debt. But then, of course, they got whatever other assets. They got $14 billion in property, plant, equipment assets, whatever. And that's, see, now in most companies, that's a bullshit number, but with a phone company like that, that's a real number. That's their lines and their systems and all that. There's actual value to that stuff. They got $500 million in cash. They had $8 billion for a while that we spent it on the Verizon customers. They have $500 million in cash, and cash flow. Oh, okay. The cash flow was minus 253, but they paid 178 in dividends. Minus 209, they paid 178 in dividends. So by cutting this dividend in half, this gets cut basically in half also, and they're only losing $100 million. And that means with $500 million in cash, they've got $570 million in cash. No, $500 million in cash. Balance sheet, yeah, $500 million in cash. That means that they can. And also, by the way, look at how the receivables run up because they added all these customers. The receivables go through the roof, and that looks like an impact to their profitability, but it's not. They just have a lot more receivables. They have a lot more customers. It's a very tricky thing to transition into this whole thing. But the point being, they can sustain the cash burn they have now for at least a full year. And so they have another full year before they have to even worry about whether or not they can turn things around. And obviously, right now, they're doing all this stuff, and they have to stabilize their business, and they have to keep things in line. But once they do that, and then the people like Moody's get a little more comfortable with their situation, they'll get upgraded. And then when they start getting upgraded, they'll start flying higher. So it's a long-term hold. And it might go lower, and people might, you can just as easily come out and say, oh, there's no way they'll do this, and there's no way they'll do that, and blah, blah, blah. That's fine, because frankly, it can keep going down. And I will certainly, realistically, at 160, at probably 120, I'd want to buy some more, and then at 80, I'd want to buy some more. But right now, we just bought a whole bunch at 170, so we're going to see what happens. But really, if we buy another 10,000 at 80, that's $8,000 more dollars. So we're certainly in for that, right? I'm not going to get out at 80 and take an $8,000 loss when I can buy $8,000 more. Especially if we still think that it's a silly move down. So even if it drops 50% from here, I'm still buying. And there's no good reason it should be at 160. There won't be any good reason it should be at 80 either. It's just you can look at all these things two different ways. You can always look at them and say they're out of business. It's like Baker Hughes. Like last year we were saying, having the same conversation about Baker Hughes. And I said, I can't even understand what people are thinking of that they don't value this company higher. I couldn't even imagine what people look at. Weight Watchers. Oh, by the way, in the options opportunity portfolio, Weight Watchers just exploded. Because again, it was the same thing. I'm like, I don't understand what people are looking at. It could not be more obvious to me that this is a ridiculous price. So now here we are at the 20s. That's why we picked it. We picked Weight Watchers around here or whenever. And not only we pick it, but remember we bought it. Oh yeah, we bought it here, and then we bought it again because I was like, it's still cheap. Yeah, it was the first stock we've ever had two different spreads on at the same time. I'm like, I can't take it. I can't take this price. And then all of a sudden, people realize, like, oh my God, this thing is so much more valuable than we thought. That's what Frontier is going to look like. This is the same concept with Frontier. You can sell off and sell off and sell off. Or here, look at this thing. Sell off and sell off and sell off to nothing. It's bankruptcy. All of a sudden, oh my God, no, not bankrupt, $28. Then boom, then feeling like bankrupt again, and oh my God, oh no, $28 again. It's idiotic because people that basically don't know how to value a company. Unfortunately, with Weight Watchers in the options opportunity portfolio, we are probably going to cash it out because at this point we have a 5-12 spread. So we bought the $5 calls for $6. We sold the $12 calls for $3 or $2.60, and so we're going to make whatever it is. The most we could have is $7, and the net of the spread is now $7. 19 minus 12.20, so it's 20 cents less than the full payout, and it's 2 years to go. So we're going to have to cash it out, unfortunately. I hate it when you have to cash out a stock that you love, but what are we going to do with it? It's pointless. It can only make 20 more cents in 2 years. There's no reason to hold it. All right, and one day Frontier will look like that. But you have to buy. Super Value is another one. We bought more. In fact, we have 50. We're 50 long now, and now everybody's like, oh, look at Super Value. It's like, well, duh. We didn't start out with 50. We started out with a reasonable amount, but it went down. We bought more. That's how these trades are designed. Okay. Here, same thing. $5. Down, 320, and all of a sudden, boom! Everybody suddenly goes, oh, wait a minute, this is valuable. People do not know how to value companies. Way more so than when I was younger too. I mean, when I learned valuations and things like that back in the 80s, and and again, I learned it before. My grandfather used to talk to me about the basics and fundamentals of businesses, like in the 70s. But in the 80s, I actually studied this crap, and at the time, there were very few value investors. Now, the people who call themselves value investors are a joke. The analysts are ridiculous. I don't even understand why these people get paid money. They have no idea what they're talking about. They know one little thing, and they latch on to that like it's the only important thing. They convince the readers that it's the only important thing. They like say, oh, because of this little thing that Elon Musk might do, this is a $10 billion, $100 billion company. And it's like, come on, it's ridiculous. It doesn't make operational sense, but they don't know anything about operations because these people who call themselves analysts have never actually worked in the industries that they cover. It's just freaking journalism majors. It's really horrible. It's scary the way people value things. And that's why you see stocks go up and down 20% on earnings. And everybody's shocked. It's like, how can you be that shocked? How can you cover a stock and be 20% off on what it's actually worth? But your numbers are completely wrong. It's amazing to me. People put up with this crap. Anyway, so yes, we're sticking with Amazon at the moment. I guess FTL, blah, blah, blah. Okay, great. Fantastic. It is now time to end the seminar. So thank you all for coming. I hope we accomplished something. Let's see how we're just finishing up on our trades. Market is up a bit, but that Russell is killer. That's bad. You see, and something we were talking about in member chat is that these the small cap stocks, people are realizing the smaller companies are not making all the money. The weak dollar has been really boosting the earnings of the companies that do a lot of business overseas. Not real. It doesn't mean they earn more money. It means that they earn more dollars because the dollars are weaker. So the European money and foreign money they collect seems more valuable. But it's not like they did anything. Oh, plus the buybacks. Oh my God, Apple is buying back $200 billion of their stock. They're only a $700 billion company. They're buying 30% of their own stock back. That is crazy. They've got $200 billion set aside to buy their own stock. And why shouldn't they, though? It's the greatest company on earth. But, I mean, honestly, you're not going to be able to own Apple at a certain point. There will be no more stock to own. So it's, I don't think they'll take it private, but I just think it's going to get harder and harder to buy shares, and that's going to make, if they do something extraordinary, it's going to go up like crazy. So I still like being in Apple and playing Apple long term. Other than that, everything looks copacetic. And so, like I said, still long on silver. I left that in because I didn't think this was enough of a move. Well, I was greedy, but we'll see. Still long on coffee. I like gold at $12.50. Oh, see, gold's below $12.50. So when gold goes over $12.50, that's a good time to get in and use that $12.50 line for a stopping line. Anything over $12.50, though, I love that bullish. Oil, we're long at $47.50. That's already taking off. We're back at 48. Gasoline. This is not the holiday weekend, but you know what? Frankly, I wouldn't mind being conviction long above 150. So in other words, if you start buying here, you want to plan on having a contract here, 153. If it goes lower, you want to add an average in down to the 150 line, but you're going to risk it's a big loss. It's $420 per contract. So if it drops 3, that's like $1,200. So let's say you buy one at 153. Then at 150, 150, you would add another one, and your average is going to be 152.25. Okay, and you'd be down about $1,200 there with 2 contracts. Then if it goes down to 150-ish, you want to buy it like, let's say 150.25, and your average would be would be 151.25, right about here. Then you'd have 4 contracts, but you'd be down from 151.25 to 150. You'd be down 125 on each, which is $500, let's say, on each on 4 contracts. So you basically, what I'm saying now is that strategy risks a $2,000 loss, a little bit more than $2,000 loss if we go below 150 and you stop out. But having 4 contracts at 151 heading into Memorial Day weekend, if we get to 160, that's $4,000, that's a $16,000 gain. So the risk reward, when you look at it that way, is you're risking $2,000 to make potentially $12,000, and the premise, is that right? Like So I'm sorry, to make $16,000, and the premise, so you have a positive risk reward ratio. And the premise is it's a holiday driving weekend. It's the biggest driving weekend of the year. You have the OPEC meeting where they may extend the cuts and drive oil prices up. So there's a lot of positives moving to the holiday weekend. But you don't want to play the current contract because the current contract expires before then. You want to play RB N7. That would be July. The next contract, we're in the June contract now. You want to play the RBN7, which is also a 153. Wait, what? Is that right? Oh, yeah. Okay, so the RBN7 is barely any more money. So I would play RBN7 at 153.25, and then I would add more at 150, 150. That would be 2 times, and I would add more at the 150 line. And at that point, you're down about $2,000, and at 148, I mean, at the very least, I would probably lighten up if we go below that line and then add more back at 148.50. It's a little more complicated now. I wouldn't stop. That's the problem. I wouldn't stop that. But I'm just saying, as a risk reward, even if you set a tight stop there, as a risk reward play, you're risking $2,000 if you stop out tightly here. I wouldn't. I would keep going. But if you stop out tight here, you're risking the $2,000 loss. Versus if we go up past 160, which is right here, that's a 7-cent gain times $400 is $2,800 times 4 contracts is $10,000. So even if we just go to 160, that's where you're going to be. Or actually be a dollar lower basis of 14. You know, like that $14,000, $16,000 total if it all works out well. And then the thing about gasoline, when you have the trade, the wild cards are maybe OPEC does something, maybe war breaks out, maybe maybe some other disaster happens, something that causes oil to spike. Oil is a lot more likely to spike up and spike down at any given time. So there's always like a sort of net positive to being long on oil. Because at any given time something weird could happen and makes you money. So in a case like this, we're coming into a weekend now. We have a holiday weekend 2 weeks, 3 weeks from now, the holiday weekend, big driving holiday weekend, and OPEC is meeting at the end of the month. There's so many good reasons to go long on gasoline. But it has to be the RB N7s because the current contract expires before the OPEC meeting. So, you really kind of want to keep that catalyst in place. All right, so on that note, thank you all for coming, and we will do it again next week. All right, take care, folks. No, they raised it to $200 billion. Telling you.